Hello out there, DGI investors. It is Colby, the DGI Crab, coming at you here on a Sunday, August 24th, 2025. And what we are finding here over the past few weeks is that just like in 2024, with some little dips along the way, for the most part, the stock market remains on fire. And there's just not a tremendous amount of good deals out there. And a lot of the stuff that I've been emphasizing purchasing over the last 3, 4, 6 months, well, even some of it that still looks like it's underpriced, is recovering to the point where even that stuff's not tremendously interesting. So we're going to go over what to do in a very hot stock market video as we examine the 60 dividend growth stocks that this channel focuses on. That's right, if you are new, this channel emphasizes just a group of 60 high-quality dividend growth stocks split into 4 separate tiers based on the age and time horizon of the investor, which I believe is the most important metric that any dividend growth stock investor should take into consideration when purchasing their passive income investments. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. My personal strategy that I'll go over in this video is as follows. We're going to put about half of investable dollars into age-appropriate ETFs for automatic diversification. And when it comes to those 60 individual single growth stocks, we're looking for 30% or more above the 4-year average yield. I'll show you what that looks like when we get into the spreadsheet. Now, I have a personal top 10 favorite dividend growth stocks. And sometimes I personally will purchase any of the stocks of that group of 10, whether they look to be undervalued or not. Stuff like Microsoft, Waste Management, Procter & Gamble. And then I really try to remain within my personal age tier, but sometimes you see a stock, the yield's 50% or more above the 4-year average yield, and it just looks like too good of a deal to turn down no matter how old you are. And if there's not a buyable stock in my tier, I will not invest less for that particular week than I was planning on. I'll just simply add more to the ETFs because I'm not really trying to time the market week to week. I would like to time the market in the sense of when I'm buying my individual single stocks, but when it comes to just overall invested dollars, not so much. So we hop into the 4 tiers spreadsheet here. I have things organized here by the valuation tab. The stuff that shows up in the green is the stuff where the yield has entered my buy zone, meaning it's at least 30% off the 4-year average. Anything else, it's not stuff that I sell. I'm not really an investor that sells my stocks. The only way that I would consider selling anything prior to reaching financial freedom would be for just an outright emergency that was for a lot of money, was, hit me for more emergency cash that I had available on the side. It would definitely take a lot. So I'm just going to hold all the rest of the stuff that's not currently in the buy zone. I'll have dividend reinvestment turned on across the board for all of my investments. And I'm getting this number, guys. Look, I'm just taking the 4-year average yield, which I update every single week. So this is going to be an up-to-date number every time you watch this video. And then I'm comparing that against the current day yield and just seeing how far off is this from this. Pretty simple stuff, you guys. So United Health and Nike, but they've been the dogs in this tier for quite a while right now. Nice to see Nike finally showing some signs of recovery. UNH, I think, hit the absolute basement when it fell down into the mid 200s. I don't know how long it's going to take them to recover back up into the $600 range that they were in at one point earlier just this year. But for right now, I'm still very happy to buy both, especially UNH. I'm getting a 2.88% starting yield on this one still, when the 4-year average yield is a mere 1.46. So definitely still adding to UNH each and every week. And then Nordson, which has been in the buy zone for a while now, just slipped outside of it here. 4-year average yield of 1.3 or 106, currently yielding 137. And it looks like $227 a share is right around the cutoff line for Nordson when it comes to me. Now, this group of stocks here, you guys, I've just realized I forgot to preface it here. This is just the tier one stock. So this group is for the 18 to 30-year-old investors, preferably, because they're getting a low starting yield on all of this stuff, really. Even the stuff that's in the buy zone, it's fairly low starting out. But the point of this group of stocks is we want the collective dividend growth rate to be well above 10%. So those young investors, 30 and under, they've got time in the market to let those double digit dividend increases hit their account year over year over year and really start to snowball some passive income. Now, tier two, the 31 to 41-year-old investors, this group of stocks is going to yield a little higher. It's going to be, not in that 1% range. This is like 2 to 3% range yield stuff here. High single digit, 7, 8% dividend growth rate. There's 19 stocks in tier two. It's the largest tier of the four tiers here. We've got three stocks in the buy zone. We've had as many as five in the last month or so, but for right now, the primary dog is Target, which dropped back down below $100 a share. Still a nice value. As I keep insisting here, you guys, I think the dividend growth for Target is going to be pretty low for the foreseeable future. I do think that their dividend overall is safe. You're getting a very nice 4.5% starting yield uh, to help you build your position further. I think that there is going to be a point in time where Target does get back to doing larger dividend increases. But if you look back over the years on Target's dividend increases, they do tend to be a little bit streaky, where they'll have a couple of years in a row where that's really small increases, which it's what we've been seeing lately too. 1, 2, 3% increases. And then they'll get really hot. They'll do 2 or 3 years in a row where they're doing 15 or 20% increases, and it gets really wild. So they're going through a slow cycle, trying to get their online shopping and their warehouses for shipping out products, just the e-commerce side. They're trying to catch up now to Target or to Walmart and Amazon. I think they're doing an all right job so far, from what I can tell, but I don't spend a lot of time researching that kind of thing. All I know is that their dividend continues to be safe. Probably shouldn't expect huge dividend growth out of them. AWR bumps off Hershey here for the number two spot. Love AWR as a stock. Super long and consistent streak of increasing the dividend. And then Hershey, which has just been my favorite thing to buy for, gosh, like 6, 7 months plus now. At one point this week, it recovered enough, it slipped out of the buy zone. And I was pretty happy about that, but it also is bittersweet as well because, it's just been so fun to buy, and I knew it would eventually recover. I've got a really nice position in Hershey right now. Um, Continue to keep your eye on McCormick. It dropped down below $70 a share at times this week, which at that point I added to my position. And then it recovered pretty nicely on Friday, bringing it out of the buy zone. But just keep an eye on McCormick. Anytime it drops below $70 a share, that is just a good, safe buy, in my opinion. Tier 3, age 42 to 53-year-old investors, starting yield's going to start to get a little higher in this group, 3, 4% starting yield. Growth rate starts to slow down a little bit too, more than that 5% range year over year dividend growth. Hormel and Pepsi. Oh, excuse me. Pepsi being one of my top 10 favorite dividend growth stocks. All the ones that show up in bold here as we've gone are in my personal top 10 list. These remain in the buy zone. Pepsi remains a high priority add for me. Hormel got that dividend yield climbing up near the 4% range again. That's really kind of the sweet spot for me. I know that it's currently in my buy zone at 396, but if it really drips down right around 29 a share and I'm getting a yield at better than 4%, that feels like a pretty good sweet spot for Hormel. And then ADM, you guys, hey, another one. Talking about buying Hershey forever. I've been adding little bits to A&M or ADM here and there for quite a long time now too, and they've finally gotten out of the low 50s, high 40s, up to 62. Not even close, really, to being in my buy zone anymore. Oops. And this really was one that has been, up or near the top of the list for quite a while now. In terms of buys, the yield had climbed up above 4%. So, guys, if you were buying ADM with me for the last few months and getting a starting yield above 4%, you've got to be feeling pretty good about that right now, because a lot of you have seen about 25-ish% increase on your share price if you're getting it down there in the 40s. So that's why we buy stuff when it's on sale, because it eventually will recover when it's stuff like this that has very long track records and wide moats. Tier 4, age 54 and older, higher yielding stuff. We probably want to get at least 5% starting yield for the vast majority of the stuff that we buy once we get up into our mid late 50s. Don't want to throw dividend growth entirely out the window. You still want to get 2, 3, 4%, on this stuff when you can. So that way, when you're living off of high yield stuff like this in your retirement, you're not reinvesting dividends very much, if at all, anymore. You still want to get some dividend raises even out of this kind of stuff. Uh, Smallest group of the 60 on the channel. We've only found 10 that had good high starting yield and consistent dividend growth to make the cut for me. This has not been a group of stocks that has had a great value to it. As a matter of fact, this channel, more than a year old, been doing these videos every week. Check out the playlists on the channel, by the way. You could go back and look at what I've been buying every week, all the way back for, gosh, more than a year now. Like I said, never seen anything in the green on this particular tab in this particular group. Realty Income has flirted with buy zone on occasion, but this high yield stuff these stocks have really just been darlings as far as how they have performed. Our three REITs in the group here, Essex, NNN, Realty Income, are the most undervalued in the group, but I'm just still not finding anything that looks like a good deal here. But guys, I'm going to tell you, even though I'm not 54 and older, there a couple of years ago I was buying up shares of Altria because they had dropped down into the low $30 a share and the starting yield had hit 10%. And it was just too much for me to turn down at that point. Since then, obviously, the share prices have more than doubled in value. They've done a couple of 4% dividend increases in that point in time as well. And that's just looking like such an amazing purchase. But would I be adding Altria right now, getting a starting yield at 6%? Absolutely not. Happy to just sit and hold this one. All right, you guys. So the purchase breakdown for the week for the age tiers for me would look like this. So as always, half of the money just automatically goes into ETFs. Not trying to time any of this stuff, you guys. The 30 and younger crowd, 25% S&P 500, 15% small cap value, 5% VIG for growing dividends, and 5% VYMI. Keep your eyes out this week, you guys. I'm putting a video out this week, long anticipated. I got another couple of challengers to go up against VYMI, my favorite and only non-US stock investment. Tier 2, same four, different weights: VIG 25, VOO 15, VBR 5, VYM 5. Tier 3, focusing more on dividends, and I hit that 42 to 53 range. SCHD, VYM, DHS, that's the kind of stuff I'm looking for there. Tier 4, be sure to check out my ETF video regarding income investments, you guys. Lots of additional coverage on why this larger group of ETFs is how I break down my income seeking recommendations for that group. Not official stock advice, just what I'll be doing when I hit that point. Uh, and then, emphasis on the stocks, you guys. If I'm in tier 1, United Health is going to be my top priority. Then Pepsi and Nike after that. Nordson and Target would probably be the ones I would go after those top 3, but just about 5 that overall in the buy zone for tier 1. For tier 2, I've got in my own category there Target and AWR and Hershey I can add to. UNP, I'm personally still adding a little to. It's undervalued enough, and it's in my top 10 stocks. Same thing with Procter & Gamble if I was in tier 3. So, all right, you guys, that's the video, and that's the breakdown. You can pause here to look at the allocations if you want. I've got to run right now. I hope you are having a wonderful week. weekend. Keep investing, make a plan, and I'll keep in touch as the week goes on.